Hello, welcome. This webinar is Paying the College Bill and Borrowing, hosted by Scholar Service Center. I'm Corey Murphy. I've been in and around this industry in one capacity or another for almost 20 years now, working privately with parents and students just like you. My co-host is Luann Lee, and you'll get to meet her a little later in the presentation. Welcome, first of all. We are so glad that you're here. Now, for some of you, you're just getting started on this paying for college. And then for others, you may already be well overwhelmed with repaying your loans. So we're here for all of you. We can assure you that you are in the right place and that this will be time well spent. Okay, a little bit of housekeeping though. We are not recommending one option over another or giving investment advice in this webinar. We don't know you and your specific situation just yet to be able to make those kind of recommendations. You must consider your financial situation, your goals, your risk tolerance when selecting the appropriate method for you and your family to pay for college and to borrow. Each payment option that we're going to go over and each loan option presents its own unique advantages and disadvantages. So we do really encourage you to consult with licensed professionals, consult with us for a personalized guidance and personalized advice. Our agenda tonight is going to be in two parts. So part one, I'm going to go over various options to pay the college bill. We're going to dig deep into those federal loans for students and parents. We're going to go over some general borrowing rules. How much is too much for students to borrow for their education? Different types of loans that are available to borrow from, and questions to help you determine your best loan options. And then I'm going to pass the baton to Luann, and she is our certified student loan professional. And she is going to dig into public service loan forgiveness, income-driven repayment plans, and then show you some case studies of people and the differences that they've been able to make. All right, so these are all your options, and there's a laundry list of them, right? Payment plans, there's loans, there's 529 accounts, there's lines of credit, all the things. The challenge is when you get to that point of paying the college bill and we get our financial aid award, we ask the college, what's next? And the college is going to say, here's a student loan, here's a parent loan, we'll see you in the fall. Right? But you have so many other options to choose from, and what's best for you is going to be very specific to your situation. So we're glad you're here, and this is what we're going to go over tonight. Let's start with payment plans. Payment plans with colleges allow you to spread the cost over that academic year. A college is going to have a third party that sets that up with you. There's probably going to be a enrollment fee, $25, $75. Not every college will have this option, but if your college does, it's a good one because there's no need for credit checks. There's no approval process. You just sign up and get rolling. No interest is going to accrue on that money through the academic year. Okay, there are some disadvantages though. If you miss a payment, that could lead to penalties or a hold on your student's enrollment. It also offers limited flexibility on how much you pay each month. It's going to be very specific so that everything's paid by the end of the semester or even a little bit before. Some of you may have taxable investments, custodial accounts, brokerage accounts. These can absolutely serve as a supplemental source of funding. It gives you quite a bit of flexibility on when to withdraw those funds and just withdraw them as you need them for college expenses. The disadvantage is that making that withdrawal is going to stop that uninterrupted compound interest in the account. Making withdrawals can cause taxable events, so it may generate a capital gain. Any dividend income or capital gain income that shows on that tax return is going to increase your adjusted gross income. That then goes on the next set of financial aid forms and could increase your student aid index. And so if your student aid index goes up, your need-based financial aid could go down. So just need to be aware of that. 529 accounts, lots of you have those. Absolutely gives you the flexibility to withdraw as needed for college expenses. And you can actually do it in two ways. You can have the funds paid directly to the college for the bill or the open invoice, or you can pay the open invoice and have those funds come back to you as a reimbursement for those expenses. You have that choice. Withdrawals from 529s, as long as they are qualified education expenses, they are going to be tax-free. If you make any withdrawals for non-qualified education expenses, the earnings portion of that withdrawal is going to be taxed and penalized. Okay, and it is just the earnings portion, not the entire portion. On a penalty, it's going to be a 10% penalty. And on the income will get added to your regular income and flow through to your adjusted gross income. On the 529s, you're wondering now, what is a qualified educational expense? Okay, that is going to be tuition and fees required to enroll at the eligible college or institution. Eligible being if they take a FAFSA, then they're qualified. Expenses for room and board. Course-related expenses such as fees, books, supplies that are required as part of that degree program. And some of the stuff you might pay to the bookstore, you might pay somewhere else. So you want to keep those receipts and track that yourself. Also, in those 529s, if you are fortunate enough to have money left over, you can use $10,000 of that 529 to pay towards qualified student loans. Now, qualified educational expenses do not include travel, research, clerical help, anything that's not required for enrollment or attendance to pursue and finish that degree. So IRS publication 970 is the Bible on the 529 withdrawals and the qualified educational expenses. Another thing to know about your 529s, the college is going to issue you a 1098T, and that looks like this here. It comes at the end of the tax year, not the end of the academic year, but the tax year. In box 1 right here, that is going to be the qualified educational expenses that you've incurred at that college in that tax year. Box 5 here is the scholarships or grants that you've received in that tax year. Now, you do not pay taxes on scholarships and grants. That is not why you're getting this form. This form is for reporting purposes only. You're going to give it to your CPA or your tax advisor, and they're going to do the math for you. We'll go over a little bit of it. They will do that math for you. These scholarships and grants, the reason I bring this up and what I want you to know is the number in box 5, the scholarships and grants, do reduce the qualified educational expenses. So the gross amount being 1, box 5 being the scholarships and grants will give you your net or your adjusted qualified educational expenses. So that's why I say keep the receipts for the other stuff so you can add that in. Anything that you pay to the bookstore isn't going to show up on this 1098T. Okay. All right. So here's why it's important. So let's say we have $20,000 of qualified educational expenses in box 1. We didn't get any scholarships and we took 20,000 out of the 529. Perfectly fine. We have 20,000 of qualified educational expenses. 20 came out of the 529. 100% of it is tax-free. Super. Now, another scenario here is with scholarships. So let's see our same $20,000 of qualified educational expenses and then 10,000 of scholarships. So now our adjusted qualified educational expenses are the 10. But we took 20 out of the 529. It's okay. How this works is we have 10 of the adjusted qualified expenses. So 10,000 of the withdrawal absolutely tax-free, penalty-free. Now, 10,000 though is subject to the tax and the penalty. And you'll want to talk to your tax advisor or your CPA about how best to handle that because you have options. You might choose to pay the tax and the penalty on the earnings portion of that withdrawal. Maybe it's very minimal. You may choose to return that overage to the 529 and use it another time. Okay. Or you may choose to pay tax on the scholarship. We're not going to get into all the details of that. I just want you to know that you do have options and at the end. All right. Another thing to talk to your tax advisors and your CPAs about is the American Opportunity Tax Credit. Now, this is phased out for higher income earners. If you make less than 160,000, you get the full tax credit. If you make over 180,000, there is no tax credit. And then if we're in between the 180 and the 160, we get a prorated amount there. Okay. This credit is for qualified educational expenses paid to an eligible institution. Okay. The maximum credit is $2,500. And if you owe zero taxes and the credit takes you below that zero, you can get up to $1,000 back refunded to you. Now the credit itself is 100% of the first $2,000 that you spend on qualified educational expenses. And then the next is 25% of the next 2,000. So that's how we get the additional 2,500. Okay. More about this tax credit. Qualified education expenses used for your tax-free 529 withdrawals cannot also be used for this tax credit. We can't count them twice. And again, your tax advisors and CPAs will be able to do this with you. Students must be claimed as a dependent on the tax return to claim the credit. So sometimes we get a question of if we have divorced or separated families and they want to split the credit. No, the credit goes with the student and the tax return that student is seen on as a dependent. Parents, if you're over income and your student files a tax return, then they may be eligible or able to show that they've paid those college expenses and then take full use of that credit. It's a little tax planning strategy there. And again, CPAs, tax advisors, well-versed in this. We just bring it up now so that you can proactively inquire about that before the tax year is over. Your CPA is going to ask you after the tax year and when they're in the midst of preparing your tax returns. All right, other ways to pay for college. Cash gifts from family, right? This gives you immediate access to these funds without interest or repayment obligations, gives you the potential to maybe avoid student loan debt altogether. Maybe it's offered as a loan and that family member forgives that loan after college. I've seen a lot of different ways that this comes about. Now, there are annual limits per person, per gifter, according to the IRS. And something to be aware of, the tax advisor CPA may say to pay that gift directly to the college, pay a bill to avoid those annual limits and gift taxes. I would just say, as a tiny bit of caution, if you're receiving need-based financial aid from that college, we don't want to pay that directly to the school just because we wouldn't want them to see that that is an additional resource and have that affect future need-based financial aid. All right, let's take a breath here and the general borrowing guidelines before we get into all of your loan options. When we're talking about loans, we're often asked, how much is too much to borrow? General borrowing guideline is not to borrow more than that student can earn annually in their career job after college. Okay, so a business degree, a communication degree, humanities degree, statistically, those students are going to start and earn a little bit less than a computer science, engineering, or math and science degree. So these are the guidelines. And honestly, we could talk to three different families and have three different borrowing strategies, just like no one investment is perfect for every single person. No one loan strategy that we're talking about today is going to be perfect for every single person. All right, so let's dig into the loans. You have the option of doing a home equity line of credit, right? These are typically a lower interest rate compared to other educational loans. They do give you the flexibility in borrowing and repayment. Those interest rates are going to be determined, though, by your credit score and the risk to the lender. Interest rates can be fixed or variable depending on the lender. You may run into some closing costs or fees. The challenge is that this puts your home equity at risk if you're unable to repay that loan. Life insurance loans. These are popular. Gives you access to the cash value of the life insurance policy without having to surrender the policy. These are typically lower interest rates compared to traditional loans. There are no credit checks. You actually are using the cash value as collateral to secure a lower interest rate loan. Any loan on your life insurance is not going to be a taxable event, so it will in no way affect your financial aid eligibility. It does not interrupt the compounding interest of the asset. In your life insurance loans, they're not required to be paid back. And that may sound too good to be true, but they are not required to be paid back. Okay. 401k, 403b loans. Some of you have thought, well, could this be an option? This is probably the worst option of all, to be frank. But these conversations come up when we're talking to families who are up against the wire to make that final college pick, and it just isn't looking like it's going to be affordable. So families will panic and go to this source. The problem is you're borrowing against your retirement savings, but you can do that and without a credit check. The maximum that you can borrow is $50,000 or 50% of the vested balance, whichever is less. So 50,000 or 50% of the vested balance. You'll find lower interest rates compared to traditional loans. These will not impact your credit score, but it does reduce your retirement savings and potential growth of your account. If you were to leave employment from that employer, it's called employment separation, you will be required to repay that loan. So you either repay the loan with other money or it's treated as a withdrawal and then potentially subject to tax and penalty, just like a withdrawal, a straight withdrawal from that account would be. You'll find private student loans. So private loans are fixed, they're variable, they have some limited flexibility for repayment. Students are going to need a cosigner unless your student has a qualifying credit score and income. Loan amounts are going to be capped at the cost of attendance minus any financial aid that was received. And that interest rate is going to vary. It's going to vary based on the credit worthiness of the student and the cosigner and the risk to the lender. There's many lenders out there. These are just a few that come across our emails and mailboxes. The challenge here is there is no potential eligibility for loan forgiveness or income-based repayment plans. And that's what we're going to talk about in the second part of this webinar is that loan forgiveness and income-driven repayment. Defaulting on private loans is going to have severe consequences, including wage garnishments, damage to credit scores, all the bad things. Can get approved pretty quickly in 1 to 5 days-ish. Okay. Some states that you live in have loan programs where the state is loaning money to students. Not every state. Loan amounts are typically capped at a little bit lower amounts. They are typically in the name of the parent and the student, so that can be attractive. Interest rates are very competitive, typically reserved for in-state residents attending in-state schools, okay, except for two anomalies. Rhode Island and Iowa, here's their websites, they will lend to anyone in the country going to any school in the country. Outside of that, it's going to be for in-state students attending in-state schools, but quick approval, 24 to 48 hours on that. And then some colleges will loan their own money to students who are attending. So investing in students in their institution. Again, attractive interest rates, repayment options, although no eligibility for the loan forgiveness and income-based repayment plans that we're gonna talk about. Borrowing limits are going to be capped at the cost of attendance minus the financial aid that was received. And as always, with any loan, defaulting on that is going to have some severe consequences, credit scores. We're going to have problems with enrolling in classes going forward and finishing our degree if we're defaulting on the college-specific loans. Okay. Federal student loans. This is probably your best option for loaning money first for school, for financing school. It is in your student's name only. They need no cosigner, no credit history. The only requirement is that they do the FAFSA form and then they can participate. These are fixed interest rates. They will have the most flexible repayment options of all loans. They are eligible for income-driven repayment and loan forgiveness plans that we're going to talk about here in a bit. Federal student loans also have a death and disability waiver. So heaven forbid something happened to that student, those loans would be forgiven. And there's no prepayment penalty. If you don't want to burden your student with college debt, you can have them use these loans and pay them off the day after they graduate. There's no prepayment penalty. And then they establish a credit score along with it. Okay. Here's where we're at with the loans. Students as a freshman, the maximum that they can loan is $5,500. As a sophomore, second year, 65. Junior, senior, third year, fourth year, 75 and 75. Now it is broken up into two tiers. This first tier here, the 3,500, that column, if you qualify and the school is the one that certifies this, that portion of the loan can be subsidized. And what we mean by that is that the federal government is subsidizing the interest on the loan for as long as the student is enrolled in college. Okay. And then the tier 2 is always going to be unsubsidized, the 2,000. So up to this amount can be subsidized or unsubsidized. The tier 2 amount is always unsubsidized. And then here's our totals. For this coming academic year 24-25, we do know that these federal student direct loans are at 6,533. Now, a thing about appealing financial aid awards, because we always get this question too, is the college can see to what extent you've taken advantage of the federal loans. So if you don't take advantage of those and you expect that you're going to have a special circumstance appeal, then it may affect that appeal. So what I mean is the colleges will expect you to utilize the federal loans. And if you don't and you go to appeal, then they're going to expect that. If they expect that, they'll make that part of their answer. So that could lessen the effect of your appeal or deny it altogether. If you have utilized the student loans and you're appealing, then you're again demonstrating your additional need for aid. All right, now parents, we can use the federal loan system as well, and it allows us parents to borrow on behalf of our dependent students, fixed interest rates, flexible repayment options, no income requirements for eligibility. However, we cannot have adverse credit history. So adverse credit history is we have to have a 670 credit score or better. They will take a 2-year look back at that credit report. No bankruptcies within the last 7 years, no tax liens. If you have any of that, we're not going to get approved. But if you can't get approved or you can't qualify, parents can go and get an endorser, and that's like a co-signer on that loan. The federal parent loans also do have this death and disability waiver. So again, heaven forbid if anything happened, the loan would be forgiven. Now, the disadvantages are that parents bear the sole responsibility for repayment of that loan. And then here's all 3 of the federal loan categories and the interest rates. So the direct, subsidized, and unsubsidized loan, the first one for undergraduate students, that's the 6533. Direct unsubsidized loan for graduate and professional students, 8.083. And then for us parents, that direct plus loan for parents of undergraduate students is the 9.083. So your interest rates are a bit higher, but you get the 2 benefits of the death and disability rider. And these federal loans are the only loans that are eligible for public service loan forgiveness and any income-driven repayment plan. And we'll go through those in just a bit. On your college's website, it's going to show up something like this. On your award letter, it's going to show up like this. And then it's a 2-step process. And I always like to point that out. You're going to accept the loans on the college's website, telling them that, yes, you're going to participate in the federal loan program. But then you have to go to studentaid.gov and actually complete the loan requirements. And when you're there, you've been there, this is the same website that you filled out the FAFSA on. And the very next tab over to the right is that loan and grants. And that's where we go and take care of those action items and walk through those steps to secure that loan. All right. So what we talked about so far is everything that pertains to paying the college bill, borrowing guidelines for your student for their first year of school throughout the rest of their education. All of that and those decisions are what you're going to work on probably in the next 1 to 3 months. Okay. Part 2, and everything that Luann is going to talk about here in a second, is managing that student loan debt, minimizing those costs, understanding that you have repayment options and may even have forgiveness options. And these actions are going to be taken 6 to 12 months prior to finishing college graduation. Just get them through, get it paid for, and then 6 to 12 months before they graduate is when you circle back and dive into the analysis and all of the things that Luann here is going to talk about. Okay, so I will hand you controls, and there we go. Luann Lee, everyone.
All right. Well, thank you, Corey. And the good thing is we've got some case studies here in just a few slides, which everybody always enjoys. So again, I'm Luann Lee. Like Corey, I've been in this industry for 20 years now. Started in financial services and realized, hey, if I can show people, parents and students, how to reduce overpaying for college, by $100,000, that's probably $500,000 in their retirement. So, and a lot of it has to do with the loans that you choose. So we're going to go ahead and go into the basics of managing your debt with the federal student loans. So we're going to start with, there's the 2 more popular and well-known and probably the most confusing. And one is the income-driven repayment, which is called the IDR, and then the public service loan forgiveness, which is PSLF. And so we'll start with the IDR. And the biggest thing about income-driven repayment programs is, just like what Corey was saying, you you're going to start the other steps in 1 to 3 months from now. But this is a time when you probably want to start doing some thinking about, geez, should we use the federal loans or the private loans? Are we possibly going to qualify for forgiveness once things happen? Because there is strategic income and tax planning that makes you get to the best result. So you want to make sure that you've got qualifying loans. We'll show that there's a number of different loans and repayment plans to choose from. So it gets kind of complicated to make sure that you're choosing the right loan program. The key with income-driven repayment, everybody pretty much can qualify for this as long as if you've got more loan balance than you have income. And again, that goes back to strategic income and tax planning. Then it will behoove you to look at the IDR payments or the IDR program. Now, the key with this one is it's going to go for 20 years. You don't have to be with a certain type of employer or anything like that. You just have to make sure you've got more loan balance than income. 240 on-time payments, or it can go up to 300 on-time payments if it's a combination of undergrad and grad school loans. If you're taking on Parent Plus loans, that will be for undergrad, and that will be 240 on-time payments. Now, there will be taxable consequences on that forgiven balance at that time, which again goes back to the first tile. Tax planning comes into play, and we'll show you a couple of case studies so that you can think about what to do. So this infographic I took straight off of the studentaid.gov site, just so that you can see it does get complicated. There's different types of loans. There's different types of repayment plans. It's kind of like the puzzle of getting into college is the puzzle doesn't end there. You have these puzzle pieces afterwards on how to end up paying for it strategically. So the public service loan forgiveness, or PSLF, the most confusing and wrought with misinformation. So the background of PSLF is it started in 2007. President Bush in Congress wanted to say, hey, we have all these people that are going into public service. Deliberately, they know that they're going to earn less to serve the public. So let's give them some enticement. And if they've taken on a lot of education loans, let's give them some forgiveness in this. Now, doesn't mean that you're not going to pay anything. You're still making payments, but again, just like the IDR program, and you do have to have an IDR type of repayment to qualify for PSLF. If you have more balance than income, very strategic. So again, making sure that you're in the right plan. Now, this has got 120 on-time payments, which means at the end of 10 years, typically, your balance will be forgiven without any taxable consequences. And that's a nice enticement to work in the public sector. So the big thing about, other than making sure that you've got more loan than income, is your employment. You must be working full-time with a qualified employer. And full-time means 30 plus hours. What's a qualified employer? If you work for the government, whether it's the federal, the state, or county government, you are with a qualified employer. I spoke to a dad just this weekend. He works for the IRS. And he was asking, is this for real? And I said, absolutely, it's for real. But it's not government contractors. So I live in Northern Virginia. We're surrounded by government contractors. Unfortunately, you're not going to qualify. So just be aware of that. And also nonprofits, a qualified nonprofit, 501c3. That is also a qualified employer. Again, 30 plus hours. Now, a lot of nonprofits, I've met a lot of parents that work part-time for 2. As long as you have a total of at least 30 plus hours, that will work as well. So everybody thinks it's just teachers, isn't it, that can qualify? No, you can work for a school system. You don't have to be a teacher. You can work for a nonprofit hospital and be a nurse or a doctor, or you can be the janitor that's working at a nonprofit hospital or at your county school that's taken on Parent Plus loans to get their kids through Stanford, and you'll qualify for public service loan forgiveness. You can be a police officer, firefighter, in the military, be a federal prosecutor. It's your employer. It's not the job that you do. And that's where people get so much misinformation. Now, you're going to hear a lot of very nasty things about PSLF. It doesn't work. There are people that were on it for years and years and they never got forgiven. You know, that's true. Because, you know, it started, like I said, in 2007. In 2017, there were a lot of very excited people that thought, oh my gosh, I'm going to get my loans forgiven, get this elephant off my back. And many of them did not qualify. Why? Because they were in the wrong loan program. They were in the wrong repayment plan. They consolidated their loans from federal loans into private loans because the interest rate was better, and then found out that they could have qualified, and then now they can't go backwards. And they were just given a lot of wrong information from who? By the loan servicers. And so I'm just going to tell you that when you pick up the phone to call federal, the student ed or federal, any of the federal loan servicers, they are not there to give you financial information. Should I do this and whatnot? They're just there to give you the basics. And sometimes those basics that they're giving you is incorrect as well. Kind of like when you call the FAFSA hotline. So just be aware of where you're getting your information from. So Parent Plus loans. So many think, well, this doesn't qualify for Parent Plus loans. Yes, it does. If you, the parent, are working for a qualified employer, then you can have your Parent Plus loans consolidated to be paid, included in PSLF. The thing is, though, it has to be for 10 years again, but that's 10 years from the time that your student has graduated as an undergrad. So it's when they graduate, you start doing paperwork, and at that time, you're on that 10-year clock. Now, I'm going to share with you, some of you that maybe in the audience, you already have a student that has graduated, the sense of urgency that you should have, because there's big changes that are coming down the track in just another month. We're in June right now. And it's called the SAVE repayment program, or SAVE, stands for Saving on a Valuable Education. And this is going to be the new income-driven repayment plan that I think is the best thing that has ever happened to any of the forgiveness plans. Because the key factor is that you know, we've all heard about the loans that just keep getting bigger and bigger and bigger, and we'll never get them paid off. Well, with the income-driven plans, you know, you're going to pay less than the interest and less than the principal. And so for most of the repayment plans, that was always tacked on to your balance. And so then by the end of the time, you know, that 20 years or 25 years, you would have to pay taxes on that balance, and it kept growing. Well, with the SAVE plan, that balance is not going to grow. And that's huge. Now, if you're in public service loan forgiveness to qualify in an income-driven repayment plan, it's not going to matter because your balance will be forgiven without any taxable consequence. So remember that. The key factor for those of you that maybe you just had a student graduate and you have those Parent Plus loans is right now you can consolidate those Parent Plus loans. It's called a double consolidation. I'm not going to get into the weeds of it, but it takes a good 3 to 6 months for that to process. On July 1st, 2025, the ability to consolidate those loans into a SAVE IDR payment is going to go away. So it's a huge savings for those that can still qualify. And so if this sounds like you, definitely fill out the form to see if any of this is going to be beneficial for you at the end. So let's go ahead and go into the case studies. This is the best part of any presentation, I think. So this example here is public service loan forgiveness. And so I've got it broken down. Just remember, the tile I said strategic income and tax planning. So this is why we say that. So I met this young lady. She's person number 1, and she's the college counselor at a local high school. She's not a teacher. She's a counselor. And so when we met, she, was pretty sure that she had done all the right things to consolidate her undergrad and her grad school loans, and she thought that she was on track. She said, "Could you please check this for me? I really hear all the horror stories about people that don't qualify." And I said, "Oh, absolutely." She was going to let me come in and do a presentation for the school. So I said, "Oh, yes. I mean, by all means, I'd love to help you." So person number 2 is her husband. Now, his income, quite substantially more than hers. She's the only one that has the education loans. So we've got their joint income, adjusted gross income, that was $138,000. They've got 2 little ones, toddlers. So I said, let's go ahead and let me plug in your married filing jointly, but also let's take a look at married filing separate. And so down here in the left corner, we see that, well, that means that they would probably pay an additional $1,214 in taxes. And they said, well, that doesn't make any sense. And I don't think our CPA is going to like this. So I sat down and showed the CPA, just like I'm showing you with the software that we've got. So initially, they were in the pay plan, the pay as you earn. And married filing jointly, it takes both the spouse's income to calculate what the payment will be. And at the time, it was $801 per month. Now, they had about 6 more years, or she had 6 more years of repayment. And her payment was going to go up because her husband had just gotten a pretty nice raise or a job, increase or promotion. Thank you. And so his salary was going to go up enough that it was going to increase their payment to $1,200 per month. And she said, "We're really struggling making that payment. We're not able to save for, our retirement and such." Well, changing to married filing separate and, a few other things into their tax reporting, it brought her payment down to $137 per month instead of that $801. So $8,000 a year they're saving. And once the CPA understood this, he was on board. He said, "How come I didn't know about this?" I said, "Because you deal with taxes. I deal with this." So this example here is a family. They don't qualify for public service loan forgiveness. They will qualify for income-driven repayment forgiveness, which is going to go on for 20 years. Now, in this example, it's parents that have taken on Parent Plus loans. And a little bit of background, person number one, that's dad. Person number two is mom. They own a dental practice. Now, mom's the dentist. Dad is on the payroll. Dad has always been a government contractor making some pretty good money. His health changed. Didn't have any long-term disability insurance or anything like that through his employer because he didn't know the benefit of that. And so their family situation changed. Then COVID hit. And so then the dental practice suffered. They have two students that they're taking Parent Plus loans that are at very highly selective colleges that are very expensive. So again, we looked at, okay, let's separate the taxes, and of course, talking with the CPA. So if we looked at with the Parent Plus loans, so the standard 10-year repayment would have been $2,577 per month for a loan balance of $219,000. This was a family that they were struggling. I mean, they had to sell their home. They almost lost it. So we came down to the ICR payment, or the income contingent repayment, which will be the only repayment that you can use in the income-driven repayment plan for Parent Plus loans after July 1st of 2025. So you look at, my gosh, the payment was going to increase even. But when we separated their taxes, it brought that payment down to $870 a month, which, was very doable, saving them almost a little over $30,000 a year. But remember, they own their own business. So their accountant got busy and said, well, we can just change the income around. And all we did is they still have the $234,000 adjusted gross income, but just change the buckets of the income. And so $2,200 in tax differential, but we're looking at bringing that payment down to $70 per month. That's a savings of $40,000 a year for this family that has no retirement. They still have their students that are at these schools, and they're going to be taking on even more loans. And dad's health is not great. So remember what Corey said as far as the life and disability riders, in a sense, that's the fee that you pay for the federal loans. When dad passes away, none of us, even his doctors, don't think that he's going to be here for another 20 years. All of these loans will go. So that's a life-changing situation for this family. And, that's why you need to do that strategic income and tax planning when you're thinking about the loan options that you should be looking at. So Corey, do you want to go ahead and take over?
Super. I will wrap it up. Thank you. And those numbers are amazing. So to recap, part one, we talked about all the options to pay the bills to the college for your student. And that's action that you are going to do, depending on when you're watching this webinar, you're going to do every summer and every year before your student starts college in the fall. So file the FAFSA, secure the loans, think about how they're going to get paid back. That happens every single summer before college starts in the fall. So again, FAFSA, secure the loans, pay the bill. Managing the debt, analyzing those repayment options, minimizing those loan costs, that is work to be conscious of now, do some research on, some homework, but the action itself happens 6 to 12 months prior to your student graduating college. When they're 6 to 12 months from graduation and heading into repayment, that's when the formal analysis can happen and we can see what loan repayment options are available, where they're going to go work, and make some decisions there. So we say connect back for the analysis, develop your best repayment strategy, and discuss the forgiveness options. Okay. And then save on those monthly payments, right? So what's next after this webinar? You're asking those questions of yourself, of your partner. Are we taking the right loans right now? Is your student in college and are you concerned about repaying those loans? Maybe am I eligible for an income-based repayment plan or forgiveness? And am I on the right plan, right? There's so many questions. We've borrowed for older students and now we have younger ones coming and we have issues and questions and we're overwhelmed and we're stuck and we're unsure. So we have help. We are here with a solution. What we want to do is invite you to complete our college loan analysis questionnaire. It is free. It will ask you a series of questions about income and loans and outstanding, and if you work at a public employer. Submit that, and within 24 to 48 hours, we'll be able to take a look at that and give you back some information on qualification status, some loan information, and recommend some next steps for you to take. So that's a QR code. It's a link to the questionnaire. Again, it's a free questionnaire. Submit that in there, and within 24 to 48 hours, we'll be able to take a look at it and get you some good information back. Okay, so thank you, Luann, as always. Thank you everyone for being here, and best to you all.